What is going on, Moon Gang? I am very, very excited to bring you this particular interview because, as we all know, within Ape Nation at large, there are a whole host of questions between dark pools, payment for order flow, and that's exactly why we are once again bringing on today Mr. Dave Lauer, an expert in the subject matter, to answer all of our questions. How are you doing today, Dave?
Good, Matt. Thanks for having me.
More than happy to, and I'm sure the Ape Nation at large is beyond excited for this particular discussion. So before we get into it, I find that it's really easy when we're talking about this. Within this community, there's a bit of a, let's say, a trust issue. So I guess, could you give us a little bit of your background and why you feel that you have expertise on this and like can fairly speak on dark pools and payment for order flow?
Sure. Yeah. I've been involved in markets really since, well, I was trading as a kid, but during the dot-com bubble. But professionally, I've been involved in markets since about 2005, and a lot of that involved building technology for exchanges, for brokers who were building alternative trading systems at the time, or dark pools. Building out technology for high frequency trading desks. Then I became a high frequency trader. I'm sure as many people know, briefly worked at Citadel in 2009, and then worked at a different high frequency firm in Chicago, where I did everything from mathematical and quantitative research and development of trading strategies to software development and implementation of those trading strategies to running them in production. So I got a really good experience of sort of the whole pipeline from data and modeling to trading, and some experience in sort of the clearing and all of that, especially because I worked on some trading strategies that went cross-border. So there were all sorts of things we had to deal with to do that. So that was sort of the first part of my career. And then the second part has been since I left high frequency, and left I mean, well documented really publicly for ethical reasons. I didn't like what was happening to the markets. And I had intended on leaving finance entirely, but I ended up kind of getting sucked back in and testifying before the Senate. And that was in 2012. And so, is am I like I was asked once, am I a Manchurian candidate that high frequency sent out to infiltrate things? And I can tell you that I was scared for my family and my safety at the time. I had rumors that were being spread about me around Congress. It was an intense and insane experience for someone who was really just a software developer. And so it really made me kind of realize, one, I thought I was doing the right thing, and I was an independent voice. No one was independent at the time. The only people who knew about high frequency trading were high frequency traders or stock exchanges or brokers. No one else was out there representing institutional asset managers. So I thought that's really what I should be doing. And so, for the 10 years after that, I've worked on behalf of American retirement funds, pension plans, mutual funds. I helped them better route orders and understand how their brokers were treating those orders, understand how high frequency trading was stepping in the middle, and doing unnecessary intermediation, how to detect that quantitatively in data. I helped design new exchanges to help sort of mitigate the impact of high frequency trading by trying to change the dynamics of the latency race that had been created by the stock exchanges in order to make more money from high frequency trading firms. So, all I can say is I've been doing this for a while. I've seen many different parts of the market at a very sort of applied micro level. I've looked at lots of data for lots of different people. Some of it I can't even talk about, but always sort of fighting the good fight. And I think that's all I sort of started in this community was just trying to help people understand markets, and that's what I continue to do.
On a personal note, I very much appreciate that. And I know, speaking for a large amount of members within this community, we definitely appreciate your time and everything that you do. And out of, I guess, my own curiosity, so obviously you have a whole host of employment, and then eventually you ended up becoming a person who is outspoken, shedding light on what's going on to, let's call it, the community at large, the US and world population at large. So was there one day that you really just said, like, you woke up and you just something, I guess, like morally you said was unethical, like was just eating away at you, and you said like I need to do something different, or was it more of a longer process? How did that actually play out?
Yeah, it was one day. It was May 6th, 2010. It was the flash crash. That definitely was the moment that things started to change for me. And this, I think again, like you can go back because the stuff that I said at the time, contemporaneous to slightly after that, about a year after was when I left. It's all public and documented. So like I actually I left HFT about a year after the flash crash, after trying to push the firm that I was working at into a different direction in terms of like the policies that were being advocated for. And when I was told that since those policies might impact profitability, they weren't the kind of thing that they were interested in pushing for, that was kind of my cue to leave. And so it was funny because I was 31. My wife had just become pregnant, and I quit my job and we moved into my mom's house. So I was unemployed with a pregnant wife and homeless, essentially. Not home, but living at my mom's. And I said, I just want to be done with finance. I don't like this industry at all. And I started building a storytelling website with a friend of mine, and I told this story of why I left high frequency trading. And someone from the NPR program Marketplace heard it and asked me to come on and tell that story. And it was about the ethical issues that I had with the industry. And again, this was 9 years ago. And that just kind of kicked everything off. Suddenly, I'm getting a call from the U.S. Senate and from the SEC and from these guys in New York building a new stock exchange at IEX, and it kind of showed me that I could get back in and I could push for what I thought was right, and make a career out of it, which was sort of doubly exciting. And so I got back into finance because of that.
Hey, and look at you now. Now you're talking to a YouTuber who works from his basement. So full circle. Well, we very much appreciate it. So I think maybe one of the best ways to frame, like it is in the weaves discussion about dark pools and about payment for order flow.
Yeah.
So maybe the best way to set this up is for the retail trader. We're sitting there, whether we're trading from our computer, our phone, and we find a stock like AMC or GME, and we click the buy button. Can you
Mhm.
take us what happens from there? I click buy. What is the mechanisms that are triggered from there?
Sure. And so first, when you go to click buy, you're seeing a quote on your screen. You're seeing a bid and an offer. That's called the NBBO, the National Best Bid and Offer. And it means the highest priced bid, the highest price order to buy on the public stock exchanges. And that's an order that is displayed. And the lowest priced offer, lowest priced order to sell across all the stock exchanges. Again, these are displayed orders. Someone posts an order to everyone in the world and they say, I want to buy this many shares at this price, or I want to sell this many shares at this price. And they take risk to do that, right? They by posting an order, you're taking risk. So when you as a retail investor or trader see that NBBO, generally you're going to be what's called a price taker. So the people that are posting orders on lit exchanges are price makers, and the people crossing the spread, buying at the offer or selling at the bid, those are the price takers. So let's just take that example because that's most of retail trading is crossing that spread. So you hit the buy button, GME's quoted at an offer of 160, you say I'm going to go buy it at 160 or 180 or 500, whatever it's trading at that day. And you go and you hit the buy button, and pretty much through most brokers, what happens is that order goes to the broker and they are connected to a couple of what are called internalizers or wholesale market makers. But 80% of the trading that takes place in the wholesale market making sector is Citadel or Virtu. So your broker will take that order and send it most likely to one of those two firms. Those guys are getting orders all the time from all sorts of different places. They are connected to all of these retail brokers. They are connected to every stock exchange. They are connected to a bunch of dark pools. They have single dealer platforms that act as what are called ping pools. They are managing huge amounts of inventory up and down throughout the whole day. So your order to buy comes in. In the simplest example, Virtu will see that order. They will say, I have, that guy wants to buy from me and I have inventory to sell to him. So here you go. Here's your 100 shares because I just bought this 100 shares from someone who wanted to sell 2 seconds ago. Now I'm going to deliver it to you. And that person who sold 2 seconds ago sold at the bid. You're buying at the offer. I just took very little risk, 2 seconds of inventory risk, and I captured the spread, which is the difference between the bid and the offer. I'm happy. That's profit. That's the profit I'm looking for. And so that's sort of the simplest use case. There are situations now at the front end of that trade, when someone came in and wanted to sell some inventory, maybe Virtu was flat, and they decided that they thought they were going to be able to offload that inventory quickly. So they committed capital. They said, okay, I will buy that from you. I will take on some risk. And then this person comes along and they can offload it. So, as a market maker, they're always trying to manage their inventory, manage their exposure and risk. And if they get into situations where they have too much, they can try and lay it off on the stock market and the stock exchange. They can try and lay it off to institutional asset managers. Some of them connect through those single dealer platforms, like I think Virtu's is VEC or VEC Link, and Citadel's is Citadel Connect. Through those systems, there are all sorts of other people that are connected, and so all day, every day, Citadel and Virtu are trying their best, in theory, to stay flat from an inventory perspective and just make the spread. That's the theory of this wholesaling and internalization, and the reason that brokers send their orders to Citadel and Virtu in this situation is twofold. Sometimes it's for payment for order flow, and other times it's just because there's price improvement opportunities as far as Citadel and Virtu will show statistically. And we can get into whether those are good statistics or not, but that's the case, is that they are able to show that. And because the stock market in terms of exchanges is broken from an incentives and a conflicts of interest perspective, so that these exchanges, who are for-profit entities, are also called self-regulatory organizations, and that makes them quasi-governmental, and it means they have immunity, they have legal immunity. And so why this is important, and the reason I'm bringing it up, is because let's say Fidelity wants to buy shares that are going to be in an IPO on the NASDAQ, for example. If that IPO goes wrong on NASDAQ, which has happened in the past, Fidelity has no legal recourse against NASDAQ because NASDAQ is legally immune. But if Fidelity is going through Citadel or Virtu, then they have recourse. They have a counterparty that they can sue or they can hold accountable if they need to. So, the problem with market structure, which is what we're talking about, is it's very difficult to talk about small parts in isolation because everything is kind of interwoven. And so you can't get into the problems of off-exchange trading and payment for order flow, without getting into why it even exists, which is this crazy, esoteric, weird legal immunity and access fee issue over on the exchange side. So, I'm probably rambling a bit here, but it is a problem to try and talk about individual issues when everything is sort of interconnected and markets are just relatively complex.
Okay. Yeah. Before we hop into more of those specifics, I don't want to lose anyone here. So please correct me if I'm wrong. When you hit the buy and or sell button, but let's just say in this example that you're buying, you hit the buy, and basically we have a mechanism of when you're looking for a seller, and the stock market plumbing we have right now to facilitate finding you a seller because you're trying to buy, it happens on a venue. And it seems like we have three major types of venue. The first type is a lit exchange, the NASDAQ, the New York Stock Exchange, and I believe there's about 12 others, 14 in total. So that's one type of venue. Once again, just facilitating connecting a buyer and a seller, or a seller to a buyer. And then it sounds, those are all exchanges. And then it sounds like we have two different types of off exchange. One of these is, I guess, what you're referring to as this duopoly between Virtu and also Citadel Securities. And these are guys who are functioning as market makers. And they you said the terminology internalizers, so they can facilitate taking the other side of the trade. And then I believe if anyone wants to Google this, one thing they would be referred to as is as a non-ATS. And then your other third option of a venue is an ATS, alternative trading system. And I think a lot of people in this community better know that as a dark pool. So did I get that all right thus far? There's three major venues: lit exchanges, dark pools, and then also market makers.
Yeah, that's right on. The other thing is that you can look at as lit exchanges, dark pools, and then everything else is called OTC trading or over
Okay.
the counter. If you go on the FINRA Transparency website, you'll see a bunch of ATS stuff, which is dark pools, a bunch of OTC stuff, which is over the counter, and that can be sort of a host of systems. But yeah, the market making and internalizing is the main part of that. Yep.
Okay, so maybe let's start off with that internalizing and the payment for order flow for the people out there who are just hearing this payment for order flow or the acronym PFOF. What is that?
Yeah, so that's it's an inducement for order flow, a monetary inducement for order flow. And so what that means is Citadel and Virtu will pay retail brokers like E-Trade or Schwab or Robinhood uh, a certain number of mils per share. A mil is a tenth of a cent. So, if they're paying 10 mils per share, that means for every 100 shares they get sent, they're getting 10 cents. So, you send them 100. So you, as in Robinhood, send Citadel or Virtu a 100-share order. Citadel or Virtu pays you 10 cents for that order. And then, so that's payment for order flow. It also exists to a certain extent on exchange, where exchanges pay rebates mostly for resting liquidity in a maker. It's what's called a maker-taker model. But then there are some that are inverted exchanges where they pay a rebate for people to take liquidity. And then you have someone like IEX who's unique amongst the exchanges in where they don't change their fee structure or pay any rebates. They just charge a much smaller amount for both sides of the trade.
Okay. Why? I guess so. It sounds like they're paying to take the other side of the trade. If I buy on one of those brokerages you just
Right.
mentioned, it could get routed to one of these market makers if they're engaging in payment for order flow, as in they really want to take the other side of that trade.
That's
Why?
right.
Why? Why would they do that?
The main reason is that you are operating on a completely different time scale as they are. So when I am a high frequency trading firm, I am trying to understand exactly what's about to happen over the next, let's call it 50 milliseconds, right? Not even half a second. 500 milliseconds would be half a second, and that's pretty long time scale for a high frequency. What I'm trying to figure out is, okay, right now it's trading at 180 by 180 spot oh 01. And in the next 50 milliseconds, is that bid offer going to tick up to oh 01 by oh 02, or is it going to tick down to 99 by oh 00, right? And so that's what the high frequency trading firm is trying to figure out. What is going to happen on the next tick? And so the thing about your order is that you have no knowledge of what's about to happen on the next tick. You have no insight or information about what's about to happen even over the next second. But maybe you have a very strong view on what's going to happen over the next week or year or whatever it is. You're on a very different time scale than they are. And so what that usually means is it means that your order flow is non-toxic. It's not subjecting the market maker to what's called adverse selection. So adverse selection is probably the most important term that really nobody's ever heard about or understands. And it is the core of market making. And what it means is I don't want to buy shares in something that is about to tick down, because if I do, now I'm losing money.
Okay.
That's adverse selection. So if a huge order comes through the pipes that is selling a bunch of shares, and all these market makers have to buy, and that order knows that that price level is about to be cleared out and it's going to tick down, that is called a toxic order, and that subjects a market maker to adverse selection. So retail orders do not have a high level of adverse selection. They're profitable to trade against in the very short term. And if you're good and you don't take on inventory risk as a market maker, then you don't care what happens over the next hour, day, week, month.
Okay. So would you say it's accurate to state that basically market makers have figured out a way to profit off of an asymmetric data advantage? They just see what's going on, they use that data, and they not necessarily front run, but because they have superior data, that's where they're making their money.
Yeah, they make their money because they've got this tremendous investment in infrastructure and computing, and they're able to see feeds that are proprietary and being sold by the exchanges that are very fast, faster than the public data feeds, right? So the feed that you're seeing on your broker's website is the SIP. It's the Securities Information Processor. That's the public market data feed. But the exchanges are selling private market data feeds that are faster to these HFT firms. They're also selling them to brokers now, but the speed advantage is real. These guys have computers co-located in data centers next to exchange matching engines. They use lasers and microwave technology to send data wirelessly, even faster than through fiber optics. Because when you send data through a fiber optic line, it bounces off the glass inside the wire, and that can add nanoseconds or maybe even a microsecond of latency. Whereas if you send it straight through the air, it doesn't bounce off anything. And so even line of sight, it's faster than fiber optics. And that's the level of engineering that's taking place. When I was in it, I was managing a system that could trade in 40 microseconds. That was my average response time from when I would get a message into my server and when my software would send an order out. I mean, 40 microseconds is a completely different time scale than humans operate on. And so, yeah, these guys use all of this technology and all of these data feeds to operate at a very different time scale.
When you're saying different though, what is retail operating at? Are we on days, hours, minutes? Like I see that these people are moving way faster. What's retail moving at?
I mean, look, just the amount of time it takes you to click that mouse button, that's hundreds of milliseconds. So already it's just a completely different time scale. And it's very variable too, right? So that's what makes a market is that everyone's operating with a different theory and a different thesis, and they see things playing out in different ways, and there are disagreements as to who's right. And the way to test it is you put your money in, and you're right, you make money, you're wrong, you lose money. And it's kind of the beauty of markets. And so, I think from a retail perspective, if you're a retail investor, I mean, your timeline might be 30 years, right? If you're a retail trader, even if your timeline is 15 minutes, that's an eternity relative to these high frequency trading systems.
Okay, and when you're talking about that, you're just talking about like our career of like a trade or something like that, of like the time scale we're looking at and interested in being involved in the market versus the time scale that they're interested in being actively in that trade.
Yeah, these are when I talk timescales, I'm talking about like holding periods, right? So maybe
Okay.
HFT is holding inventory, like they're net long or net short, again, for milliseconds, maybe seconds. But you're going to be holding inventory. I don't, if you're the most active trader, retail trader, still doing point and click, it's still going to be minutes, and less active investors could hold something for months or years.
Okay. So payment for order flow, they're basically brokerages are getting paid to route their orders to these market makers opposed to a dark pool or a lit exchange. It's going right to either, let's just say Citadel or Virtu. But I mean, when I read about it, I think I've read that it's banned in the UK, it's banned in Canada, and I think its birth has some connections to Bernie Madoff. Like, so something's messing up here. Like, obviously, some people are not happy. Like, countries are not happy with it. Its connection to Madoff. Like, we're familiar with that story. So, like, obviously, something's going a bit awry here. When even we're having this conversation now, kind of like asking what it is and its efficacy, its pros, its cons.
Yeah, most countries have taken the stand that when a broker is routing an order, the only thing that they should care about is the execution quality of that they're delivering to their client. Execution quality can mean price improvement, it can mean timeliness of execution, it can mean a bunch of different factors, and that's usually up to the discretion of the broker. But Most important thing is that the broker is acting as an agent. This is sort of like you find this all over. It's called, the principal agent problem. When incentives are not aligned between the broker acting as agent, they might act as a principal for themselves, which means they might seek to reduce or minimize their fees or maximize their rebates, regardless of the quality of the execution that the end client ultimately gets. And those other countries have said that we are going to outlaw this because we want to address that conflict of interest and we want to make sure brokers are getting the best trades possible for their clients. And yes, in the US, we have not. And, I think it gets to the idea that some very politically powerful people make a very large amount of money doing this. And that's sort of the nature of the US political system.
So if they're maybe this isn't the most accurate term, but if they're front running their client, like if we have one particular market maker who cares not necessarily about their client's execution quality and just cares about them making money themselves on the trade, is that the only detriment of payment for order flow to our system, of like just some guys like they're skinning off like a portion of penny, or does it go even deeper than that in terms of its detrimental aspects to the stock market system at large?
Oh yeah, it's detrimental to the market. Let me start, before I get to that, let me just read you a quote.
Okay.
The practice of payment for order flow creates serious conflicts of interest and should be banned. Internalization without meaningful price improvement reduces competition, limits price discovery, leads to market fragmentation, and should be banned. Payment for order flow is a practice that on its face is at odds with the broker-dealer's obligations to its customers. A broker-dealer has a fiduciary obligation to obtain the best execution reasonably available for its customers' orders. We do not believe that a broker-dealer that accepts payment for order flow and does not pass such payments on to its customers can consistently fulfill its best execution obligations. You know who said that?
I don't know, like the SEC or something.
Citadel.
What would the saying for that even be? Like the pot calling the pot black? Like they're
Yeah,
like basically talking crap on themselves. When did they
yeah.
say that?
They said the commission, speaking of the SEC, should ban payment for order flow altogether. This was from 15 years ago. Oh no, sorry now, 17 years ago. This was in 2004. So before they were in to payment for order flow, Citadel believed that it should be banned. Um, the same can be said for Virtu. They were against it before they were for it. So when you hear arguments on the other side, and they denigrate those of us who have been fighting against payment for order flow. I've been in this, I mean, you can look honestly, like back at my congressional testimony in 2012 is when I started talking about this. And they will denigrate us and they will say, we don't care about markets. And the CEO of Virtu on Twitter last week called me anti-retail. So that was nice of him. But I'm just repeating arguments that they've made themselves almost verbatim. Now, to get into whether there are systemic issues, the very simple answer is yes. When you take that order flow, the retail order flow that is profitable for market makers to trade against it, so profitable that they will pay for the privilege of interacting with it, and you remove that order flow from the stock exchange where price discovery actually happens, as the president of the NYSE said, it distorts the prices on the exchange because the exchange prices cannot accurately reflect supply and demand. And so what that means is that the only orders that make it to the exchange are those highly toxic orders, the ones with high adverse selection. So it means that market makers struggle to make money on exchange. And
Okay.
if they struggle to make money on exchange, you go from narrow and tight spreads to wide spreads. Market makers have to widen the spread to make more money. And that's what she's talking about. So there was a good study that came out recently that said diverting all of that flow off exchange has widened spreads by 25% or more. So that costs pension plans and mutual fund companies billions of dollars a year in extra execution costs. And it makes it makes it harder for these underfunded pension plans to meet retirement savings needs for their firefighters and their plumbers and all of these workers that depended on these pension plans. This is why I got into the issue in the first place, because that just seems wrong. And all I'm arguing is that that order flow should go to the exchange, and you should have open competition for order flow. Get all the market makers competing over the order flow. It would narrow spreads. Retail would still have excellent outcomes, but so would the rest of the market.
Okay. If so, feel free. If you had a magic wand right now at this moment and could get rid of payment for order flow, would you?
I would not get rid of payment for order flow because, as I was trying to explain before, it's something that if you just got rid of the payments, you wouldn't fix the problem. So Fidelity doesn't accept payment for order flow, as an example, but they still route to Citadel and Virtu. So
Okay.
there are two main reasons. One is this exchange immunity issue, and the other is that Citadel and Virtu offer better price improvement than what you can get on exchange. So what you need to do is not ban payment for order flow per se. And that should be one part of a broad set
Okay.
of changes in markets. The main thing, I would like to adopt a rule similar to Canada's dark trading rules. I think they're an excellent model for a very simple and elegant rule. And all it says is, if you're going to execute something off exchange, you have to provide material price improvement. And the definition of material price improvement means a tick if the spread is more than a tick wide, or half a tick, midpoint, if the spread is a tick wide. Or you can also execute off exchange if you're executing large block orders like an institution would. That's a very sort of elegant rule. It's simple. It means that dark trading in Canada is only around 8% of the stock market rather than 44%, which is what it is in the US.
Okay. So you think it's a two-prong approach of not only getting rid of payment for order flow, but also somehow stopping all of the massive amount of orders that are getting routed to the duopoly of Citadel and Virtu in the current, I guess, regulations we have. You'd prefer to see it being closer to like the Canadian market. You think it's a better representation of fair market, I guess, price discovery is maybe the
Yeah,
best way to put it.
that's right. It's more efficient, and there have been good studies that show that execution costs in markets that don't have this level of off-exchange trading are lower than in the U.S. And I want to make it very clear: dark pools are important, and dark pools are good. We're retail orders do not go to dark pools.
Okay.
Retail orders have nothing to do with dark pools whatsoever. Dark pools are for institutional asset managers. And if I, as a pension plan, want to go buy 1,000,000 shares of Microsoft, if I put that order onto an exchange, the price is going to go crazy. If I put that order into a dark pool, I might find that another institution somewhere who comes along and wants to sell that 1,000,000 shares. And that's a very good outcome. That's why we need dark pools. But again, it should be a small fraction of trading. 8% is a great number right now versus 43% of off-exchange trading, which includes both dark pools and this retail OTC market.
I was reading some things recently that is specific to the AMC and GME community that like I've been seeing off exchange, off lit exchange between dark pools and also these market makers that sometimes the volume's 60, 70, 80%.
Yeah.
Like to my understanding, by definition, I thought this dark pool thing inherently they were less regulated. Can it be good when such a high majority of trades are executed in by definition a less regulated environment?
No, I think it's awful, and I think that you don't need anything nefarious to be going on to understand that 70% of AMC, for example, being executed off exchange is damaging the market. It's damaging the spread in AMC, and it's making it so people have to pay more. Now, when you see something like that, when you see 70% of AMC trades off exchange, if you get into the numbers, you will find 90%, 89 or 90% of that is OTC. That's Citadel Virtu and this internalization system. It's only 10% of that number that's actually in dark pools. And so it really is a very small part. The whole dark pool thing is a very small part. I think I keep calling it a red herring. The dark pool is not the issue. We want dark pools to be less regulated. That's the point of the dark pool, because that way you get more creative models. You get these really interesting efforts. There are some that do like frequent micro auctions, and there are some that specialize in block trading, and there are others that now are trading around the clock. And so dark pools are an area for the market to be creative. I think broker-owned dark pools are a bad idea for a whole host of other reasons that have nothing, again, to do with retail, and which the New York Attorney General's office and FINRA really cracked down on a few years ago in terms of the conflicts of interest. It resulted in hundreds of millions of dollars of fines. But again, that's sort of a different issue from this retail internalization issue, which is just it's completely different, and it makes no sense. There is no good argument for taking that order flow off exchange other than you have two sets of firms, the internalizers and the retail brokers, who make a lot of money because of it. And they will bring out statistics, for example, that show price improvement. But remember, if the spread is 25% wider or more, then those price improvement statistics are a joke. Because if this would be the spread if retail made it to exchange, and this is the spread with it being internalized, and this is how much you price improve, you're still worse off than if the spread was tighter and all of those orders were going on exchange.
Okay. Maybe it would be beneficial for people who are like, this is the first time hearing about dark pools, which was, remember earlier in the conversation, we were talking about 3 separate venues: lit exchanges, market makers. This is that third one, ATS, alternative trading system, AKA dark pool. What's your quick explanation of what that is and why we have one, just to really tie this together?
For the ATS side of the dark pool,
Yes.
you mean? Yeah, ATS side of off-exchange trading. ATSs, alternative trading systems, are dark pools. But Reg ATS from 1998 didn't start out as a dark pool regulation. Actually, ARCA and Island were created under Reg ATS as ECNs back then, electronic crossing networks, and they were displayed. So just because you have a venue that is filed under Reg ATS, and you have to be a broker dealer to operate that, which means that no matter what, you're regulated by FINRA. It doesn't mean it has to be a dark pool, but back then they were displayed and they would post quotes, but then those like Island and INET and ARCA were swallowed up by NYSE and NASDAQ when Reg NMS came about in 2007. So now, generally, everything that is operated under Reg ATS is an alternative trading system, is a dark pool that doesn't display orders, although the long-term stock exchange is trying to change that with a new display facility. But basically, as I explained before, dark pools are really meant for both creativity and different models, and for institutions to post large orders to try and find a counterparty. And you have nonprofit dark pools like Luminex, and in Europe, the Plato Partnership, which are just sort of founded and built by asset managers to try and match up when one wants to sell and the other wants to buy. It's unfortunately rare that that actually happens, but when it does, it's a great outcome for people who own shares in mutual funds or who have money in pension plans.
Okay, so basically the pitched utility of a dark pool is that these large players, like trying to buy a lot of size or sell a lot of size, are inherently trying to do it without showing the position beforehand. Like you just don't see the
That's
bid
right.
wall, you don't see a buy wall, and you don't see a sell wall. Like
Yeah,
it's just
yeah,
they're sitting there, aka in the dark, and they're just hoping to get filled.
yeah, that's
I
right.
feel like there might be some confusion then, because there's a lot of assumption that it somehow doesn't impact the price. Is trading on a dark pool, whether always or even most of the time, or are there some caveats, does it impact the price of an equity?
Yes. And it's very important what you just said. Does trading impact the price? Yes.
Oh,
Trading. Every trade impacts the price, whether it's in a material way or not, whether it's measurable or not. Every single trade impacts the price. So this is a very important distinction. There's a difference between posting an order on a dark pool versus an exchange. Posting an order on a dark pool does not impact the price. Posting an order on an exchange can impact the price.
okay.
Uh, Trading does impact the price, and trading, it doesn't matter where it happens. It doesn't matter if it's on exchange, on a dark pool, or OTC. Every trade that happens in the market gets printed to the ticker tape or to the market data feed, and every single trade is recorded and public. And so every time there is a trade, every computer that is listening to that market data feed gets the notification that there was a trade. It categorizes, did that was that trade on the offer or close to the offer? So it was a buy. Was that trade on the bid or close to the bid? So it was a sell. Was it a midpoint? It's every computer, hundreds, thousands of computers all around the world listening to this information, trying to figure out what that means for supply and demand, what that means. Is there lots of buying activity taking place? Okay, you're going to start to see the price move, right? Is there lots of selling activity? The price is going to start to drop. That's all based on looking at trading data and classifying it and putting it through, these mathematical models to try and understand what it means and whether there is, some signal in that trading data that can be used and profited from, basically.
Okay, so I really like this distinction between posting a trade of like saying, hey, I'm trying to buy, I'm trying to sell, and then actually trading, executing the trade. When
Right.
you actually execute, is there any delay in impact on price, a material impact? Can it be delayed seconds, minutes, hours, days, or is it instantaneous?
So the rule is that all trades have to be reported within 10 seconds. And that is a time period that has come down dramatically over the years. In fact, something that I pushed hard for recently to bring it down from 30 seconds to 10 seconds. And so the rule is it all has to be disseminated within 10 seconds. In practice, it's usually relatively instantaneous, that within milliseconds, that trade gets reported. So that is for almost every single trade in the market. They're reported instantaneously, worst case within 10 seconds. It is possible that some trades get reported late. Now, what that means, there are valid reasons for late reported trades. For example, everything we're talking about is assuming electronic trading and execution. And
Mhm.
for 99% of the market, that's how it works. Not how it used to be, right? It used to be you call someone up on the phone, yeah, I got 50,000 shares of Microsoft. All right, I'll take it down at this price. Okay, trade.
Mhm.
And then they call we call the back office. The trade happened. Okay, all right, we're gonna get to it, and it would take minutes, hours maybe. That still happens from time to time. So there is some manual trading, and it is not. They do not have the same kind of rules. They're allowed to report it a little later. There are other kinds of trades, like options trades, where you can have like you can have what's called a multi-legged options trade, where you can have one, two, three, I'm sorry, two, three, four different legs. You've got puts here, calls here, different durations,
Mhm.
different strikes, that kind of thing, because you've constructed a butterfly or whatever it is, and it could be that one or more of those legs actually gets executed and converted into shares from options. And what FINRA needs is they need all of that to kind of be reported at the same time and interconnected so that they can surveil that kind of trading activity. So there are certain exceptions for legs of complex options trades. There are other small exceptions, but I haven't done the math. I would be surprised if there was anything more than less than 1% of all trading that got reported late. I would be surprised if it wasn't 99% of all trades and all shares get reported in that 10-second window, and nearly all of them, within milliseconds.
Okay. Rewinding a little bit, you were talking about dark pools being for institutions. I remember at one point, I think I was on Interactive Brokers, and I actually saw a route option that I could route to a dark pool. So are dark pools exclusively for institutions or just most commonly used by institutions?
Right, they're not exclusively, and yeah, Interactive Brokers offers some more advanced routing, and others do too. For example, it's still mostly for institutions like RIAs. Even if they don't manage a ton of money, they might get access to the retail brokers router, the order router, and some of those can hit dark pools. But generally speaking, it's for institutions. But these are facilities that welcome retail trading. They would love more retail orders coming through because of that adverse selection toxicity issue I discussed before. And so, you know, but someone like Interactive Brokers, which is more for professional traders, like if you talk to someone on Wall Street and you ask how do they manage their personal trading account, most of the time they're going to say Interactive Brokers because of that kind of stuff. Like it's more advanced. You can customize it more. You can, you have access to more destinations, and they have order routers that you can use.
Okay, understandable. So, with it, I mean, at one point you said dark pools are good, and then like the other part you said the fact that we have so much off exchange, which is dark pools and also market makers, that's very, very bad. But do you
Right.
think it's bad specific to dark pools if it's pitching this concept that most of them are supposed to be these sizable block trades, but the data almost seems to be the contrary, where we're seeing a lot of volume, but it seems to be like a lot of little trades. Like,
Yeah.
is that problematic?
Well, see, that's generally speaking indicative of retail trades. And so that's the OTC trading. And you can do the math because you can go on the FINRA website and you can look at, OTC trading versus ATS trading. Now, I do think it's problematic. What you see in dark pools is you see, I could actually, I think I have this up somewhere. You can see an average trade size off exchange. The average trade size off exchange in July was 245 shares. Now, the average trade size on exchange was 132 shares. So the trades are bigger off exchange. But if you dissect that, actually, I think we can look at this. So let me look at these numbers real quick. So here is ATS trading. And there are a group of ATSs where the average trade size is very small. So UBS, Goldman Sigma, Credit Suisse Crossfinder, JPMX, those are all between 100 and 150 shares average trade size. But if you look at ATS trading, where's
So that was
ATS?
non-ATS. You were referring to dark pools right there?
Yes,
Okay.
so those are dark pools. Let me see, where's I don't have good OTC numbers, but when I looked at, for example, GameStop a couple months ago, I was seeing average trade sizes in like 20 shares, 30 shares.
And that
So
was
those are that's all those individual retail orders coming in and being executed immediately. Like they get executed right when they come in. And so you see very tiny trade sizes because of that.
and that was specific though to market makers. We're not talking about dark pools. We're talking
Correct.
about like
That's
OTC market
OTC
makers.
trading. Exactly.
Okay.
Yeah.
So is there actually data though suggesting that dark pool trades are of lower volume? Because right now we're expecting that they should be higher if they're being utilized in the way that we expect it to be.
So there is a set of dark pools that specialize in block trades.
Okay.
So there's bids, there's block cross, there's liquid net. So bids average block size is 25,000 shares. Block cross average block size is 20,000 shares. Liquid net 25,000 shares. So there are a group of dark pools that do specialize in that block trading. The problem is with these broker owned dark pools, like what I was talking about before, Goldman, Credit Suisse, UBS, Morgan Stanley. Um, there are all sorts of issues that we haven't even touched the surface of in terms of the conflict of interest, where if I, as an institutional asset manager, go to Morgan Stanley and I say, here's my million share order to buy Microsoft, and they're going to put that in their own dark pool where there's very low chance of finding a natural counterparty to execute the whole block, and a very high chance that it's just going to be picked apart by lots of little orders as HFT firms are trying to profile supply and demand in the dark pools by pinging into them and doing all sorts of other things. And then Morgan Stanley is also routing part of that order out to other dark pools, pinging those. It's very complicated. It's kind of a mess. But again, it kind of has nothing to do with retail. That's all. Those are all issues on the institutional side. And again, if people are interested in that, I would tell you, go look at what the New York Attorney General did. I think about in 2015 or thereabouts. It was very excellent expose on what dark pools were doing at the time and the crimes that were being committed, and there were some very large fines paid. Unfortunately, I guess I shouldn't use the term crimes because no one actually went to jail, despite all of the massive amounts of fraud.
Oh, good.
But that's sort of just Wall Street, right?
Yeah. Uh, One thing, I guess, talking about this dark pool and Citadel and that, I was reading about Citadel Connect, which you referred to earlier. And I remember reading on one article that apparently it said that they don't even have to report their volume. Is that true? Like when you're saying
No,
everything's reported?
yeah, that's not true. So Citadel Connect and Virtu offers this VEC and VEC Link. These are called single dealer platforms. So they operate OTC. They're not dark pools. And in the industry, we often call them ping pools or STP platforms. And it's a bit complicated to get into it, but the most important thing to understand is it is just one of the facilities that these guys operate for OTC trading. And everything that happens in them, every trade that happens is printed to the tape. Every trade that is printed to the tape gets included in FINRA's transparency reporting. So those trades are being printed to the trade reporting facility, the OTC. Those trades show up in the OTC reports on FINRA's website. And all of it goes to the consolidated audit trail that FINRA is now operating for surveillance purposes to try and find people that are manipulating markets and that kind of thing. So it is less regulated than ATSs, less regulated than dark pools for sure. But it is not unregulated and everything is reported. And I'm not defending these things in any way, shape, or form, as should be clear. I think all of this stuff should go away. I think markets are too complex. I think this amount of off-exchange trading in the retail space is problematic for reasons I've already explained. But I'm just trying to explain how these things work. And I know there was some Reuters article going around from many years ago, which had bad information in it and that people are using as a source. And I just think that's the kind of thing that it's not right. And let's understand the thing that we're fighting against. That's my thought.
Okay, so maybe two quick like kind of rapid fire questions. So in the AMC, GME, Ape Nation community, a hot topic is naked shorting. Does payment for order flow, which are clearly against, and then dark pools, which you do have sometimes some issues and other times not so many issues, in does naked shorting, is it made easier by payment for order flow or dark pools?
Not in any way that I can think of. And I often get hit for phrasing things like that. And people say, oh, you're just describing how things should work, not how they actually work. That's most certainly not true. I'm intimately familiar with how these systems all work in practice. But when you think about naked shorting, that's something that takes place in the back office.
Okay.
Everything we're talking about right now is what's called the front office. That's where trading happens. The back office is where clearing, settlement, and reconciliation happens. And so that's just a fundamentally different thing than all of this trading on exchange, off exchange, whatever it is. Now, it can be made easier by the fact that these firms are what are called bona fide market makers, and there is a market making exemption to Reg Show, which says that they can short stocks without having located shares to borrow, but that doesn't have anything to do with where that trading is taking place. That exemption is equally valid on exchange, on dark pools, off exchange. So when I try and say that, don't worry about that from a naked shorting perspective, that's all I'm talking about. Naked shorting happens in the back office when someone is short and they're unable to deliver shares. That has nothing to do with where that trade took place.
Okay. So let's just make this very clear. Obviously, naked shorting, it does happen. It's problematic. These just aren't the causes of it. It just happens somewhere else in the stock market plumbing world.
That's right. Yeah.
Okay. And in a very similar realm between dark pools and payment for order flow, and maybe this is necessary to split up into two ones, is it possible for these that you can think of mechanically for them to somehow stymie or stop a short squeeze in a stock?
So I have spent a good amount of time analyzing market data, looking for market manipulation. And all of the analysis that I've done is from lit trading, because when you go to manipulate markets, you're usually using both orders and trades. And if you look at all of the enforcement actions, it's all generally focused on market manipulation on exchange.
Okay.
So when I talk about this particular issue, I can only talk to my experience. Could you do things off exchange um, to try to change the appearance of supply and demand? I think it would be very hard. Like I said, when you as a retail trader send the order to your broker, you get that execution back in milliseconds, right? It happens very quickly. Um, so I can't think of the mechanism by which, for example, I've heard this theory of people blocking up orders to then, make it so that the buys happen off exchange and the sells happen on exchange. That would be a serious enforcement issue. And FINRA has all that data. They would see something like that. That it would be so blatant, it wouldn't be subtle.
Mhm.
Um, so all I can say is I don't necessarily see the mechanism. I'm not saying it doesn't happen. Um, but from my experience in market manipulation, you don't need that because you can manipulate markets on exchange. You can spoof and layer all over the place, and I've measured it happening on exchange. So, I don't know in terms of off exchange what would be taking place. But the problem is we can't see, so we have no way of speaking to it from a data perspective. And that's what I do. I'm grounded in data and math. And so if I can't see data for something, I'm hesitant to make claims that I can't back up or prove.
Gotcha. So when I was kind of researching you and looking into your Twitter, that seemed like, of course, you've had comments on dark pools, you're vehemently against payment for order flow. And one of the other things that we really haven't touched on is that you seem one of the biggest disadvantages of being a retail trader is just across the board, we're not playing with the same set of data. You who just said you're very grounded in data, it seems to be one of your biggest qualms with being retail and being a successful retail trader. And then I was seeing recently on your Twitter that you have something along the lines of trying to improve data for retail. Can you tell me a little bit? I think it's called Irvin.
Yeah, so Irvin is the company I run, and we've been focused on AI, and we also have an sort of this thing we do for compliance, helping institutional asset managers do due diligence on their brokers. But as I've gotten involved in the community and I've tried to answer questions and help people understand markets, every time I see data being posted on Reddit or something like that, not every, but a lot of the time, it's very poor quality data. And there are things in that data that shouldn't be there, that didn't actually happen in the market. But the retail brokers are not incentivized to invest in high quality data or high quality data processing systems. So that really jumped out at me, that people were seeing things that weren't there and weren't happening. And so I would call them glitches. And then I kind of got, people didn't really like that because then they said all I saw were glitches. But when I say glitch, all I mean is that it's poor data processing or it's poor quality data. And I thought, there's something we can do here. I see a problem, and I feel that if it can be fixed, let's go fix it. Let's build something better. I'm used to institutional quality data. I'm used to professional data and tools. And I know the right people in the industry. I've worked with them for years. I know the best data. And so I reached out to them and I said, hey, is there a way to do this for retail? Can we take this institutional quality data and get it to a price point that retail could afford? And they said, hey, that's really interesting. We didn't really think about that. All our clients are institutions. So maybe we can try and do that because it wouldn't cannibalize our business. And so, that was sort of the light bulb that went off and said, hey, I mean, I like building stuff. I like building software. That's what I've done for a long time now. And so I said, hey, let's see if we can make this work, and then let's see if we can provide better tools. And I was inspired by the research, like the quality of research on Reddit, where there's people digging so deep. They clearly want to learn and understand and find these issues. And I said, what if we could couple like better data and tools with a sort of purpose-built platform for producing research like that helps communities come together and pool their data or pool their intellectual resources to work on research together. I just thought that would be a really cool thing to build. So yeah, that's what we're trying to build with the terminal. The company is called Irvin Finance, and the website is irvin.finance. Um, I think most importantly, I talk a lot about incentives and alignment of incentives and the problems in the market with conflicts of interest. And I thought that the way to address that here would be to have retail investors own part of the company. And so that's why we're doing a crowdfunding campaign. And we could have, I've said it before, we could have just sold subscriptions for on Kickstarter and gotten plenty of money, I'm sure, maybe even just as much. But it didn't feel right. It felt like this would be way cooler if, just like AMC and GameStop, right? So AMC now has all of these shareholders who are their best customers and their most passionate advocates, right? And GameStop, same thing. I think that's such a cool model. So like, let's all own shares and own a stake in the kind of stuff that we love and use, and make it better. And that's just, I think it's a revolutionary model. I think it's a modern model that will, in the future, we're going to look back and we're going to see that this has become more of the standard than anything else. And I just love that.
Yeah, I mean, you're getting me excited. Just I can see I can see your passion in it, and when you can see someone's passion about it, it's just like the energy is infectious. So I'm very excited to check it out. I'll make sure to link your Twitter, so if people want to reach out to you, that's below,
Sure.
and then also link to the terminal, I believe it's called. But I'm
Yeah.
personally excited to check this out. But overall, for me personally, and also the Ape Nation community at large, we very much appreciate your time. We very much appreciate you sharing your expertise and clarifying a lot of questions and misinformation and confirming some other things. But we know your time is valuable. And once again, thank you so much for your time.
Sure. Thanks for having me on. I appreciate it. And I really enjoy it too.
All right. We appreciate it. Have a good one and enjoy the rest of your day.
Thanks, you too.